Hello and welcome. Inflation is rising. Based on the consumer price index, it has risen consistently for the past 7 months in India, reaching an 8-year high of 7.8% in April. Now, this persistent inflation, says rating agency CRISIL, is set to become the biggest headwind to India's economic recovery this fiscal. Now, on another note, investment banking firm and brokerage Morgan Stanley has said that global slowdown, surging oil prices and weak domestic demand could lead to India's GDP growth coming down to 7.6% for 22-23 and further to 6.7% for 23-24. Remember that these figures are obviously on a much lower base and therefore appear higher. So therefore the overall GDP growth impact is much are more significant. On the other hand, looking at inflation itself, it is affected primarily or considerably thanks to food inflation, which is being driven by rising costs of production, again in rising international crop prices and extreme weather related disruptions. So, and within that there is of course cost of production which is going up, particularly in the case of farms. So all in all, prices are rising, prices as you feel it as a consumer, prices as businesses feel it when they are manufacturing goods and services, because the cost of their inputs are rising, and all in all this is not very good news. So the questions are two or threefold. One is of course how bad could it get and what does that mean? Secondly, if it is getting bad, what could lead to its unwinding and what does history tell us there? And thirdly, what do we need to do at this point as we look ahead, both as monetary policy, which is interest rates, and fiscal policy, which is to provide other kinds of inputs to reduce prices or reduce pressure on the economy. On that note, I am joined and pleased to be joined by DK Joshi, Chief Economist at the rating agency CRISIL. Mr. Joshi, thank you very much for joining me, and do tell us, so this is clearly not something that has just happened. It's been gathering steam. Oil prices both internationally because of the Ukraine war and so on, but also in India have been rising steadily, and that's been contributing. Where is this headed?
Well, I think right now the pressure is broad-based. I think if it were a supply shock, let's say oil, I think you could have ignored it, I mean, because that would have come down. But here I think the pressure is coming from food, from fuel, and also from core inflation, which excludes food and fuel. So I think that becomes a worry for the central bank. So if you compare the situation in US with India, I think US, the demand is also strong, labor market is also tight, and there is a supply shock. In India, the demand is weak, but yet inflation is high, and I think it's getting broad-based. So it is a worry for both the government as well as for the central bank because of various factors. I mean, it hits the poorer most, number one. And it also creates economic instability, so to say, and I think an uncertainty as to what's going to happen on the policy front, when will be it under control. So it does, I think, in the current milieu, where the risks and uncertainties are so large, I think it adds further pressure on that.
Right. So, and I'm going to come to the supply side in a moment. Supply is really when, for example, we import things and the prices of those are high, or the prices of goods that are being sold are high. Now, why is there weak domestic demand? And that's something that the Morgan Stanley report talks about as well.
Well, I think the weak domestic demand reflects the K-shaped recovery in the economy. If you look at the GDP data that was published for 21-22, the slowest growing component of demand is private consumption, which is close to 65% of GDP. 55% of GDP. Now, I think the reason for that is that the lower income brackets, I think they haven't benefited from the recovery as much. I think whereas the upper income categories have not suffered at all, I think, during the pandemic. Actually, their income might have risen. So the broad basing of consumption demand happens when everybody consumes. I mean, so right now I think the consumption is biased towards high income categories. If you look at, for instance, automobile, the luxury segment has done extremely well. The small cars haven't done that well. And within, I think, if you look at cars versus motorcycles, the smaller ticket items haven't done well. So that's a clear indication that the recovery, there is a dichotomy in the system, and I think that's getting reflected in private consumption demand. And inflation is biting further, I mean, because it reduces the purchasing ability of the poorer people.
Right, right. And how does this contrast with what's happening in the rest of the world, either in similar sized economies or similar economies or larger ones?
Well, I think for US, I just mentioned that the demand is not weak because they pumped in a huge amount of fiscal stimulus, and there was a supply shock, and inflation turned out to be much higher than they expected. Now, I think even with high inflation, the consumer demand hasn't gone down that much. I think so. That means the monetary policy will have to stamp harder to curb demand there. And I think in Europe, inflation is high. It's largely because of energy. I think unlike US, where it is also domestic, other domestic demand factors which are playing out. So I think in Europe the nature is a little different. But so far, I think the consumer demand there hasn't been hit to that extent, but is going to get hit. Asia has been somewhat different. I think inflation has been a little slow to arrive here. But now it is becoming a concern because I think the war seems to be prolonging,
Right.
And the commodity and crude prices, I think they don't seem to be coming down, and there are supply bottlenecks coming from China, which further make the situation bad. So I think demand situation across the world, if you want to look at the summary indicator, which is global growth, is slowing down, but it is slowing down at different pace across different parts of the world, and the components of demand which are slowing down also vary across the world, I think, depending on the local
Right.
dynamics.
Right, and you talked about food prices. Now, food weighted at 39%, as your report says, is the most volatile component and one of the biggest movers of consumer price inflation. And food inflation will be driven by rising costs of production, surging international crop prices, and extreme weather-related disruptions. I referred to that in the beginning as well. So tell us about what this means. And obviously, high food prices and high food inflation means different things to different components of the population.
Absolutely. I think the food and energy prices, which are the key drivers of inflation right now, they impact the top bottom percent more, I think. And our estimates tell us that for instance, the data that came out on April 12, May 12, it shows that we computed the impact across income categories, and what we found was the urban inflation is somewhat lower than rural. So rural economy is suffering more because of inflation right now. And second, I think within each category, the top 20% of the population is facing lower inflation than bottom 20% of the population. So clearly, I think the impact across income categories varies, and this is because the consumption basket, as you rightly pointed out, varies across income categories. For poor people, I think, or the lower income categories, energy and food are very critical. For the upper income categories, I think they consume more of core items, which is consumption of goods and services of, so to say.
Right, and as looking backward and looking back and looking ahead, how does this unwind, and what could happen or what could change before we come to the specific steps? Just looking at history.
Well, I think one is that if the war ends quickly, the COVID situation in China eases, faster, and the supply side bottlenecks are eased, then what you will find is because the global demand is slowing right now, and I think because of that, the commodity and crude prices will also come down. If particularly if the supply situation eases, and I mentioned two things there, war and China, because they are most critical right now. If that happens, I think then what is happening, it will temper down the commodity and crude prices, which have already started easing a little bit, I think, in May compared to April, for instance. So I think if that slowdown will have a material impact on commodity and crude, particularly if the bottlenecks because of war and China get eased. I think that is something to be closely watched out for.
Right, but you did talk about weak demand in India, as others have been pointing out as well. So is that dependent so much on these factors or something else?
Well, weak demand also depends on inflation. As I said, higher inflation because of these factors does contribute to that. Weak demand also means, weak external demand means that you will produce less for the external market. I think that also hurts us. So there is a linkage. But I think the Indian weak demand story is playing out somewhat differently. I think what we see going ahead is that, for instance, in 22-23, now I think people have learned to live with the virus. So this year, the key driver of demand will be services, contact-based services, which have been hit extremely hard by the pandemic. Whereas the goods part of consumption, I think, will not be that strong. I think the services part will be strong. So they will tend to balance each out. But net result is, I think, continued weak demand as long as inflation is not tamed.
Right. Now, we've seen an interest rate hike, and you're also saying that while there could be another 75 or 100 basis points, 100 basis points equals 1%, 1%, that will not really have an impact on this. So what really this, and I mean that this being prices. So what then will impact prices, and what can change that?
See, I think let's talk about monetary policy first, because I think the central bank is the goalkeeper for inflation, and what they are doing is not going to bring down the price of food, is not going to bring down the price of fuel. That is very clear. But what it will do is it will slow down its transmission to the other parts of the economy, because the way monetary policy works is by slowing demand, I think it reduces its transmission to the rest of the economy. So it will curb the generalization of inflation to some extent. So that is the role that monetary policy will play. And I think people will believe that central bank is trying to control inflation, so their expectations will also get somewhat anchored. I think that is the hope from monetary policy. I think the bigger role in a supply shock comes from the fiscal policy. Here, I think the fiscal policy will have to do two things. One, I think it should and it is trying to bring down the extent of supply shock, which is cutting excise duties for petroleum products, or for that matter, I think reducing duties on edible oils, import duties on edible oils. I think all these things are going to help. But beyond this, I think the fiscal policy will also have to take care of the vulnerable parts of the economy, which means more food subsidy going ahead. It also means that since the input costs for farmers are rising, I think so fertilizer subsidy bill will also go up. So I think clearly fiscal policy will have a much bigger role, I think, in control of inflation, apart from the luck factors, which is the global developments.
Right, and if I can press you on that a little bit, I mean, what's the timeline you feel we need to be looking at for, either a reduction in import duties or further reduction in excise duties, particularly on petroleum, and import duties on petroleum, and of course food subsidy?
Well, I think it will depend on how the scenario plays out. I think if there is news of easing of war, etc., then I think you can go slow on that. But if there is further pressure, let's say oil goes up to 120, 130, then I think you will need another round of. So it is all data driven. I mean, it's very difficult for me to point out when they should do it, because I think I am not even sure how it's going to play out. I mean, it's a classic uncertain scenario. But my sense is that if inflation doesn't edge down, I think then it will have to be done quicker than later.
Right, and we do have a projected good monsoon coming, and that may obviously help things along a little bit. But in general, this is a somewhat concluding question, Mr. Joshi, what's your sense of where we are as an economy today? Are we poised for better things? Are we, have we not fully recovered from COVID? Are we likely to go back to pre-COVID times? What's your larger sense?
Well, I think if you look at the recent study by RBI, it says that it will take a number of years to wipe out the permanent loss in the economy. So that, I think, is a given. Now the issue is how quickly you wipe it out, and that depends on how faster you grow. I mean, and right now, what we see for, let's talk about what is visible to us currently, which is the fiscal year 22-23. This year, I think, will be, as I pointed out earlier, will be a year of contact-based services. And I think as we are able to move along with the virus, and I think and probably moving towards endemicity and better vaccination, etc., the services activity will support the economy. And this is one part which has not done well at all. I mean, this is it is still about 11% below the pre-pandemic level. So it will see a one-time bounce this year. That's going to play out this year. Beyond this, I think the recovery will depend on the strength of the recovery. Will depend on how the investments play out. I think if you look dial back to the budget, I mean the key driver of growth for medium term is government investments, particularly in infrastructure and the PLI schemes. So there are some good positive moves on the PLI scheme, and I think that will push manufacturing investment up. But government's infrastructure investment is going to be the key, and that the program is very laudable, very extensive. But I think the point is that this year government was hoping to spend less on subsidies and more on capex. Now I think they will have to spend more on subsidies. I mean, there's no doubt about it. And excise duty, import duty cuts also means somewhat hit to revenues. Right. So overall, I think there might be a short-term blip there. But I think beyond that, the infrastructure investment, which raises the potential of the economy, is something that will decide where you land. I mean, going ahead. Agriculture is, of course, is idiosyncratic, depends on monsoons. Services, there is an inbuilt momentum that continues. And then finally, I think what will also matter is how does this income dichotomy between the rich and the poor get sorted out as we move towards a higher growth trajectory. I think all these things are very critical, and the relationships there's also some structural changes happening across the world. So how they impact us, I think it's a fairly too many moving parts right now. But I would say that you need to monitor each of them very, very, very carefully and keep reevaluating the potential and the outcome that you'll see in the economy.
Right. And again, if you were to look back, what's the red line figure when it comes to inflation, and particularly when you look at the way food inflation is going, where, things really begin to hurt and we should not waste any further time. So we are saying 8-year high, 7.8% is the overall consumer price inflation. But obviously food, as you've said, is at 39% is the most volatile component in weightage. So what's the danger mark?
I think it's, the defined danger mark is that is 6%. I mean, the RBI's tolerance limit is 6%. So if I go by that, it's already above that. So it is above the danger mark, in that sense.
Right. And
you need to act. That's why you will see front loading of rate hikes by the RBI. And you might see some more fiscal action as we move ahead.
Right, and I guess that's something positive to look forward to in terms of response and a quicker response. DK Joshi, Chief Economist at CRISIL, thank you so much for joining me.
Thank you for having me.